focusing on banks today because Morgan Stanley had its Global Financials Conference in London last week. So 800 investors, 100 financial management teams, CEOs of all the South African Big Four banks were there. What came out of this conference?
Interestingly, not a hell of a lot, which isn't going to sound like it's going to be a good conversation for 10 minutes. But I think it's interesting in that normally the banks are a very good read on global growth. So you would think, given the global growth we've had, banks would have been, up there in terms of what sector investors, would be looking to invest in. Complete confusion, it struck me. These 800 investors, we did a pop survey of them. There was no consistency amongst them as to whether they wanted to own UK banks, Spanish banks, US banks, insurance companies, asset managers. I think there's real confusion out there as to what banks and maybe financial services in general can earn, and therefore what, once you take away liquidity of QE2 and what the new regulations mean. And so it's very hard to price a financial stock at the moment, particularly a bank.
Are they really gripping all banks across the globe together in this?
It seems that way. Certainly developed market banks. I think South African banks, we can talk about that a little bit later, are very different in that regard. But if you look across the US, so if you take JP Morgan and Citigroup, and you take Santander and BBVA in Spain, and you take Royal Bank of Scotland and Lloyds in the UK, all trading somewhere between half book value and 1 times book value. Okay, so that's kind of the market's really saying to you, these banks will not earn their cost of capital over time. It's a hell of a statement to make when the management teams are standing up there saying, yes, there are some regulatory headwinds, but we definitely think we can meet our cost of capital over time. So there's this really interesting pull between what management teams who run these banks think that they can generate with their business, and presumably the staff as well, given that they're prepared to still work in those industries, and the shareholders or the markets that are saying, hang on a sec, it's not clear to us at all that you can meet your cost of capital over time.
Is it really because they're not growing their asset bases at this stage? Because that's something we've seen with some of the South African banks. Is that a global phenomenon?
No,
at the moment?
it's much more simple than that. A lot of banks globally are earning in nominal dollar terms what they did back in 2007, but their capital base has doubled. So their ROEs have halved. And that's the challenge, is because of Basel III in particular, and country-specific rules that they're taking, where they're saying, listen, you're a banking system. Never again do we want to be in a situation where the banking system can take down the tax base of the country. We're going to require that in order to get a ticket to be a bank, you need to hold a whole lot more capital up against your assets. And as a result, the returns on capital of these businesses have been crushed.
That's something we've seen with our South African banks as well, where those ROEs have come down from the mid-20s, which we saw back in 2006, 2007, and they're trading in the mid-teens at this point for the most of them.
Yeah, and so there, for the South African banks, it's a little bit different. They are arguably overcapitalized, would be our view, and that's not a regulatory thing. I think that's management teams waiting for a bit of clarity around what the regulatory capital requirements might be, but also a little bit of a safety blanket in case the world hasn't quite recovered to the extent that stock markets would suggest that the world has recovered. And secondly, I think within that, there's a little bit of fee compression that's happened over time. So as credit extension happened in South Africa and everyone borrowed, there was less, if you like, concern about the pricing of the underwriting risk, the credit risk that you're extending to corporates and investors. And so over time, things like mortgage margins really got eroded amongst the banks. And that has an impact on your returns. Only now are the banks starting to properly price for the risk that they are giving by giving a loan to a car guy or not a car guard, a guy who buys a car, a house, or a credit card.
Car buyer.
Yeah.
Would our banks then be looking quite expensive? Because you talked about European and US banks trading on half to 1 times book value.
Yeah.
Our banks are closer to 2 times book value, aren't they?
Well, this is the challenge that foreign investors have with buying banks in South Africa. Is the management teams and the 4 CEOs are there. They will say, listen, don't underestimate the quality of the growth in South Africa. Yes, it may not be as high as Turkey or Russia or some of these markets that have very low credit penetration. However, the stability, and we've been through the credit bubble and we know what the risks are out there, the quality of our business is higher. The problem is the stocks reflect it. So 1.5 to 2 times book value when you can buy some of these global franchises with great brand names, JP Morgan, etc., at 70% to 1 times book. It's not that compelling when there's that much choice for a global investor as to where to put their money in the financial services sector.
How about the growth prospects, though? Because South African banks do have strong growth prospects, particularly in Africa. Is Africa a story that excites those investors that were at the conference?
Not enough. I mean, it may do so with Standard Bank and maybe increasingly with FirstRand, but it's, it's 5 to 10% of your earnings, and it's going to be slow to get it up to 15 to 20%. So the sort of situation where I guess ShopRite maybe finds itself is, the banks aren't quite there in terms of the appeal by the foreigners to own the South African banks for access to Africa.
Is there a new normal for banks globally and in South Africa due to the new regulations, due to Basel III? Are we looking at lower ROEs and returns on capital going forward from here?
Yeah, I think so. And I think just the function of the fact that we're in a lower interest rate environment, probably structurally, I mean, maybe we're too low right now and we're going to head up a bit, but I think inflation being a little bit more under control in South Africa compared to the past means you probably have lower interest rate environments, therefore, probably lower ROEs over time. And I think the capital base has definitely gone up, even for South African banks. So there's no doubt that the kind of 2 to 3 times book value that you might have been able to price a bank on previously because its ROEs were in the 20% range, that's unlikely to happen, I think, going forward.
So when analysts talk about buying Standard Bank if it falls below 100 Rand or buying FirstRand if it falls below 20 Rand,
Yep.
Do you think they're being a bit optimistic? Do you think we're going to see these share prices re-rate downwards?
No, I think some of that re-rating downwards has happened. So we're no longer at 2 times book value and above. And I think for 15 to 20% ROE with lower interest rates, call it, 8 to 10% interest rates, you can justify twice book value for a bank. What's going to drive our banks is whether there's a bit of growth that comes through other than just the credit cycle's turned, it's better, they're showing earnings. From there on, after that's happened, that's a cyclical thing. What is the growth rate going to be like for banks in South Africa when the consumer in particular already has a very high debt burden?
Well, there's been a lot of talk about mergers and acquisitions, and particularly of foreign acquirers perhaps coming to South Africa. But if we're saying that our banks are looking a little bit toppy at these levels or not offering enough value, do you think that the price would be a deterrent to a foreign buyer?
I've got to think so. I mean, the combination of the share price and the rand dollar, I would think it's a difficult time for Standard Chartered or even HSBC to convince its board that, listen, now is the time you've got to pile into South Africa. Unless they're thinking super long term and as a platform into the rest of Africa, there are weak sellers maybe like Old Mutual. So if you are being strategic about your investments, you've got to not only pick your timing right, but you've actually got to enter a market when you have some sellers, because you don't always get a situation where big stakes like 50% of Nedbank are on offer because Old Mutual wants to potentially sell it.
Well, some of the banks, Standard Bank in particular, have been through a bit of a restructuring process over the past while. Still not expecting great earnings this year. Do you think we'll have a bit of a consolidation until we see that earnings growth starting to come through again for the banks?
I think so. I think we're getting a little bit of relief on the fee side. So people are swiping credit cards. They may not be borrowing, but they are transacting, as you can see with things like retail sector results. The corporate sector is reasonably buoyant, and there's quite a lot of activity within the investment banks at the moment. So some of the non-traditional sort of mortgage lending, credit card lending businesses are doing better than your sort of vanilla lending businesses. And so that's going to provide, I think, a little bit of relief, and that might surprise people this year, that actually the fee income line of the banks is better than people expect.
So if you were looking to invest in a bank, would you be looking offshore at this stage?
Yeah, my personal view is yes. I think there's more interesting stuff on offer internationally, and that most banks have been painted with the same brush, which is we can't figure out what you're going to earn, therefore we're just not going to invest in you. And I think that's probably a little simplistic. And really what we need is we need the European bank sector to recapitalize. We need Basel III to be clear about what they want from the banking industry. And then I actually think you might get a decent run in the banks, as long as by then, the whole world hasn't slowed, and then, banks as a macro play on global recovery is no longer an interesting theme.